So, good evening, the lecturer of Accounting of Organizations and Society. My name is Buding Khoi, and today I will present about my individual assignment, Analysis of Information of Finance. In question 1, I was decided to analyze the RAD company, one of the three pharmacy companies besides WBA and CVS. Ratios and financial information analyzed are related to liquidity, efficiency, and profitability. In terms of liquidity, both quick ratio and current ratio describe the ability to pay the short-term obligations. The revenue USD million describes increasing in assets or declining in liabilities by serving or selling products. Overall, the RAD company was progressing in stabilizing financial performance, as all three companies' figures dramatically increased. Possible reasons are the company might have developed financial systems which helps control cash input and output more appropriately. Also, the demand for purchasing medicines might have increased quickly due to the health status globally. Move on to efficiency part. The inventory turnover provides the sign of how many times the organization's inventories has been sold in the accounting period, while the fixed assets turnover illustrated how effectively organizations make revenue from sales by using their fixed assets. Total current liabilities indicated as all liabilities in cash within 12 months or longer period. In general, with the decrease of total current liability from 2013 to 2017, while figures of inventory turnover and fixed assets turnover ratio increased, the financial status of RAD has been improved over the 5-year period. Selling products quicker, more appropriate medicines, import strategy or discounting activities might have been key reasons explained. Last but not least, profitability. The return on assets indicates how much profit earned for organizations every dollar of assets, whereas the return on equity measures how effective owners' equity being used by company to have high earning rate. The operating income USD million illustrated profit generated after the deduction of operating expenses. Overall, operating income figure from the company has increased from 2013 to peak at 2015, then significantly dropped in the year 2017. The same situation happened to the return on assets ratio. There was no record from 2013 to 2015 for return on equity ratio. The figure started peaking in 2016, then skyrocketed down in 2017. Financial strategy, such as inefficiency in maintenance costs, finance or accounting issues might have been main explanations lead to worse financial performance over the period. Now in question 2, as a long-term lender, the ability to pay debt on period and the stability of the company are main concentrations. In terms of current ratio and quick ratio, RAD financially outperformed the other two companies as either its figures significantly increased over the 5 years period or outnumbered those of WBA and CVS. Account payable ratio consolidates the statement above. To sum up, the RAD company was the most appropriate company for long-term lenders. For investor, earning maximized profit return is the main concern, as well as the operating cost of company should be minimized. Return on assets and return on equity ratios indicates that CVS financial status was more stable, sales and operating activities was more progressed, as its figure record upward trend, outperformed RAD and WBA. Earning per share USD shows the same performance of all three companies. To conclude, after analyzing and processing figures of all three companies, CVS should be concentrated to invest. And thanks for listening. Hope to have feedback soon.